Hey everybody, welcome to the live stream. Big stock split. You rarely see a 50-for-1 stock split. This might be the biggest stock split ever. You'll see 2-for-1, 3-for-1, sometimes even 5-for-1, but 50-for-1. A stock rarely gets that big where you can cut it into 50 slices. But they're going to do it. I guess Berkshire Hathaway did a 500-for-1 split when they converted some of their A shares to B shares. I think it's 500. Right? Let me make sure. 411, 623. 411. Oh, 1,500. So they did a 1,500-for-1 stock split when they converted some of their A shares to B shares. But Chipotle has the same thing going on where they never split. That's why the stock price is so high. Like each unit is so high, 2,882. Right? So I'm sure you guys know, just because a stock price is high doesn't mean it's better. Like when you look at Apple and one share is 170, some people say, how could Chipotle be so much bigger than Apple? I thought Apple was such a big company. Chipotle is one of the biggest companies in the world. But we know its market cap is the company's value, not each share price. If Apple never split, they could have a share. Their shares would be like 10,000, 20,000 each. Another wild night. Urbad, what's up? So this is unprecedented. Very rare companies do a 50-for-1 stock split. You will see people. When will the split be? I forgot when. Is it June 25th? I think I'm sure they're going to get shareholder approval. That's just the next step. Shareholders have to approve the stock split. But I'm sure it will, because generally lower share prices are more affordable and people are more likely to buy the stock. And you know this, the value of this company does not change with a stock split, whether it's a forward or a reverse stock split. It has no fundamental change in the company. It's just psychologically people are more likely to buy it. No Chipotle in your country. 207. What country? Well, you're not in Canada, because there's definitely Chipotles in Canada. What a great story. This stock has done great, amazing. It IPO'd for like 40. Now it's almost 3,000. So what an amazing run up. So it's 2,882. So on June 25th, so Chipotle shares are expected to begin trading on a post-split basis on June 26th. So on June 25th, let's just assume, I don't know what the price will be on June 25th. But let's just pretend it's let's do a nice even number. Let's just say it goes up to 3,000, just for fun. A nice round number, so it'll be a little easier for us to do the math. And then the following day, the stock price will tank. It'll go from 3,000 to 50, which is a 98% drop. So there will be people, every time there's a stock split, there's people who will say on a chat board, oh, Singapore. A lot of people on like Facebook, Reddit, stock chat boards, there's going to be a lot of people who are going to say, "Oh my God, Chipotle stock is down 98%." So some people are going to go, "This is a great buying opportunity. The stock is down 98%." Or some people will say, "The company's going bankrupt." It's inevitable. That always happens, whether it's a forward or reverse split. So then you could educate them. You could say it did not go down 98%. Just because the stock price is $60, the company value did not change at all. Chipotle's market cap will be more than Google, Microsoft, and Meta. It's almost $4 trillion. I don't get it. Are you saying it's gonna the market cap will be 50 times what it is today? Is that a joke? So if it's 79 billion, so I rounded it to the billions. If you multiply it by 50, it's 4 trillion. So it'll be 4 trillion after the split. That's a joke, I guess. It's 50x. So it's going to go from 3,000. I don't know what it will be on June 25th. I'm just assuming 3,000. So say it goes up a little between now and June 25th. It'll go from 3,000 to 60. So the stock will go down 98%. 79 billion times 50 is 4 trillion. Well, if it was a reverse split, it would go up 50x, but it will go down 50x, won't it? Won't it? Like the stock price will go down 98%. So it'll go from 79 billion to 2 billion. But it's not going down 98%. The stock price, a unit goes down 98%, but you get 50 more units. So the value of your stock is not changed at all. Do you know if there was ever a stock split this high, 50 for 1? I think Amazon might have done a 50 for 1. But I tried to Google it. I couldn't find. Amazon did a 20 for 1. Let's see. I know Tesla did a big one. Amazon did a 20 for 1 in 2022. The stock was getting high. Tesla, I think, did a big one. Oh, only 5 for 1. So has anybody ever done a 50 for 1 or higher? I don't think so. I think this is going to be the biggest stock split ever. This is the first stock split in Chipotle's 30-year history, and we believe this will make the stock more accessible. I mean, you could buy fractional shares. Times have changed. When I started trading, there was no such thing as fractional shares. But now you can buy fractional shares. So what's the difference if the stock price is 1,000, 5,000, 10,000? Well, it's just psychological. Berkshire should do a 100,000 to 1 stock split. They should, right? It's $600,000 a share. Now, I think you want to keep it above $5. So I think they should do a 50,000 to 1 stock split. When Warren Buffett dies, the owner, the new CEO, will do a 50,000 to 1 stock split, and each share of stock will go from $600K to $12. And then everybody will buy Berkshire Hathaway, and the stock and the company value will double. Market cap shouldn't change. Of course, the market cap does not change. I was joking when we did the 50x. We were kind of mocking the people who get on these chat boards who say, "Oh my God, Chipotle stock is down 98%. It was $3,000 yesterday. Now it's $60 for a share." Because people don't They just think of the stock price. That's what they think the value of the company is, the stock price. They don't think in market cap terms. I've had people on my channel who had the same thing. And what company was it? Oh, it was Ship, I think. Synergy. Yeah, Synergy. And a person was like, because some companies do lots of reverse stock splits, which artificially raises the stock price, right? A reverse stock split. Like you can see, they did a 1 for 10 reverse, a 1 for 16 reverse, a 1 for 15 reverse, a 1 for 5 reverse. With so many reverses, it appears the stock price was 15,000 at its peak. Let's go back further. Just curious. Look at this. If you go back further to 2008 when it started trading, it IPO'd at 1.75 million per share. So each share costs $1.75 million. So the person must have not went back that far. So the person on the channel, because the stock, I guess, was trading for like $15. I don't remember what it was trading at a year or two ago when they looked at my video. And his comment was to everybody, hodl. Don't sell it because it was trading over $1,000 just 2 years ago. Because you look at the stock chart and look, in March 2019, it was trading at $1,000. So it looks like imagine if it, I don't even care if it gets to 1,000. I'm going to buy it at, I think it's it's $9 today. Even if it gets to 100, which is still 10% of that price, I'll be rich. And then I commented on his comment, and I said it was not trading at $1,000. I go, it never even hit $50 a share, let alone $1,000 a share. It just appears that way due to reverse stock splits. And he was like, you know, you have a YouTube channel and you don't know how to read stock charts. Just look at the stock chart and you can see it was trading over $1,000. So I just said, you know, have fun losing all your money. I didn't say that, but in my head I said that. NVIDIA may be a split soon. Definitely. NVIDIA should be a split soon. What's it up to? Oh, yeah, it's getting close to 1,000. It's unbelievable. So it appears overvalued, Chipotle. I mean, I just did a video on them, but it will probably go up because people will feel the stock is more affordable. So it's just more of a psychological thing. Did you know when Chipotle, they had 10 restaurants in oh shit, what state was that? Colorado. 10 restaurants in Colorado. This is in the early years. And I guess McDonald's just saw something really valuable in the company. Here it is. Chipotle. Okay, it was founded in 93, so it's only 30 years old. They've done really well for 30 years. Okay, they had 16 restaurants, all in Colorado. So it wasn't that big, right? And that's when McDonald's became a major investor. That was in 98. So only 5 years after they started operations, they had 16 restaurants, which is a decent growth. Nothing crazy, right? 16 restaurants. And McDonald's saw something in them. So you might, I don't know, they might not have grown as fast without McDonald's. They have a huge backer and the most successful fast food chain in history. is a partner. So that might have helped them grow, because when you have that expertise and that knowledge and that help, I'm sure it could only benefit the company. So McDonald's, from 1998, so 8 years, they were investing in the company because they sold out in 2006. So the company went from 16 restaurants to 500. That's a really amazing growth. In 8 years, they 30x'd their number of restaurants. And McDonald's exited. Now they have 3,200 locations. So that's a good number of stores. I don't think it's a franchise, right? In July 2003, the company announced it would partner with Kuwait-based in its first ever franchise deal to expand in the Middle East. So they do franchise in the Middle East. I think that's just to get exposure in other countries, because it is hard to scaling in your own country is a different animal than scaling in other countries, because it's a lot easier to grow in your country or in your state. Could you imagine having a business? If you want to open up a second and third location, it would make sense to do it pretty close, at least within an hour drive of your house, because you have to get to other locations to manage them. When you start growing to like 10, 20, 30 locations, then obviously you're going to need a lot of help. Sorry, yeah, you were joking, HDP. I think you were joking about the market cap, right? Not changing. Well, it's okay if you thought the market cap would change, but we all knew it doesn't change. So this is a great story. I mean, I remember going to Chipotle all the time for lunch when I worked in New York City. It was so good because for $7-8 you get this huge burrito, and it's good. It tasted really good. It wasn't. It probably wasn't super healthy, but you felt better going to Chipotle than going to Burger King. But they're in a lot of countries. But what I was saying is, yeah, growing in your home country is much, much easier than going to another country. Because when you go to another country, there's a lot of obstacles that you might not even think about. I mean, you have to get licenses or approval to even go in those countries. Not every country will allow you to open up businesses. But then there could be a communication issue, especially if the country doesn't speak your native language. So if I expand to Canada, unless it's a French part of Canada, there's probably not going to be much communication issue. But if I expand to Argentina, I need people who communicate. But there's also naming. Like the names of your products have to translate. So it takes a lot of thinking. But yeah, this is a great story. Does anybody own Chipotle? I really wish I bought it. Everything. Of course, after the fact, it seems so obvious, right? But I think they're up. They've grown 50x since they IPO'd. And they IPO'd just in 2006. So in 18 years, 50x. That's pretty damn good return. But it does seem overvalued. I mean, the stock is kind of parabolic, I guess, like the market as a whole. I mean, just 2 years ago or 3 years ago, it's 1,500, which seems high, but now it's doubled already. Bill Ackman fixed Chipotle when they had problems with keeping fresh food fresh. Yes, Bill Ackman is his You can see that on Simply Wall Street. I just did a video, and as I was going through their largest investors, Pershing Square came up. So I said, that's Bill Ackman's fund. Well, this takes forever to load. Okay. Why is this so hard to... Okay, here we go. Finally. Sheesh. So here's their shareholders. Vanguard. Vanguard is usually the biggest shareholder, or BlackRock, of most companies. It's just, I think they have 7, maybe 10 trillion of assets under management. So it's kind of, it's likely they're going to be the largest shareholder of a given company because they're the largest fund manager in the world. BlackRock, Capital Research is like 2-3 trillion of assets under management. They're an LA-based firm, so I think they're the 3rd largest fund in the world. Capital Research and Management. It ranks among the world's oldest and largest investment management organizations. 2.6 trillion of assets under management. Largest investment management firms. Who are the largest? Okay, BlackRock is number 1. 9 trillion. The amount BlackRock controls, the amount of money they manage, is more than most countries in the world. Not every country in the world, but most countries in the world, they manage more than the entire country. Same thing with Vanguard. Fidelity is number 3. Okay. State Street is number 4. I thought Capital Research would be Capital Group. I think that's Capital Research, right? Okay, that's the same thing as Capital Research. State Street, Morgan Stanley, JP Morgan, Goldman. The largest non-US company is Crédit Agricole, the French company. Alliance, Capital Group, Amundi, that's another French company. BNY Mellon, UBS, PIMCO, Edward Jones, Deutsche Bank, Invesco, Legal & General, that's a UK company. B of A and Franklin Templeton. Not that this makes you a better investor knowing these useless facts, but it is interesting. Yeah, I had a quiz. Berkshire falls into an asset manager. No, I don't consider they're a holding company. I don't consider them an asset manager. But maybe, I mean, there's a lot of similarities. Because why do you say that? Were they on this list? I didn't think I saw them. Hispanic population up 600% since 1970. Because an asset manager they have lots of clients, and each client deposits money to their account. Say you deposit $10,000 a year into your asset management account with BlackRock, and they manage your money. You may pick your parameters, or there's different types of management. It may be totally hands off, where they do everything and you don't really make any decisions, or maybe you have more decision making. But it's your money. You can do whatever you want with it. You can take it out of out of BlackRock at any point in time within like a day. It's your money. Berkshire, when you put money, when you put money into Berkshire, they're like a holding company, but you have really no say in how they manage the money. They can buy they can buy public companies, private companies. They do whatever they want with the money. Of course, you can sell your Berkshire stock, but it's not really your money. The money they manage is their money, and they control it. Smash that like. Hey, Alex. But there is some similarities, but it's since Hispanics number is growing, maybe there will be one or more, or many to rival Chipotle. That is true. Maybe there will be more. Okay. Has anybody done any higher than a 50-to-1 stock split? Has anybody done like 100-to-1? Or I can't find it. Every time I Google largest stock split, this 50-for-1 comes up because it's new, and I guess it's what stock has split the most. Then there's like articles about stocks that split the most, but like I mean, some stocks have split a lot, and when you sum up all the stock splits, it's like it's 500-to-1. But do you think Nvidia? Yeah, it definitely is going to split. Because stock prices generally don't get to 4 digits. I mean, even like mid 3 digits is not common. 200, maybe 300, but it's very uncommon for a stock to get above 300. It happens, but it's not common. You see, they did a 2-for-1, 2-for-1, 2-for-1. So you have to take the product of their stock splits. If you want to know historically how many stock splits they did, you just got to take the product of the. So historically, they've done, like if they've never done a stock split, and then they did one in July 2021, they would have to do a 48-for-1 stock split just to match what they've done in the past. So they've done like a 48-to-1 stock split. If you kind of sum up the 5 stock splits, you can't add them. You have to take the product. It makes sense when you look at the stock chart. The first one was in 2000. I'll show you the stock chart. I think it'll make more sense. It may actually not make. It's hard to see though, but So let's just pretend you bought NVIDIA at IPO, the first day they started trading. So according to this chart, they started trading at 41 cents. It is hard to see even when I do it. So if you bought the stock the very first day they trading, you would have paid 41 cents a share. But we know that's not true because they were never trading at below $1. To get the price at IPO, you would take a product of all their prior stock splits times the price. So they were trading at, so they IPO'd at about 20 bucks. NVIDIA. This says 12, but it is hard to read this chart because I'm just kind of moving this needle. I can't really see these numbers. But that's how you figure out what they were trading at. If I could read these numbers accurately, it would be better. But I guess if there's a way I could zoom in. Let me try a different way. Okay, this might be easier. It does look like 41 cents. Oh, I know why. What that says $12 a share. It probably was 12 a share, but there's a lot of fluctuation, market fluctuations the first day. So maybe it was 12, but the chart is how much. It's the end. It's the closing price. The dot chart is a closing price, not the opening price. Candlestick. So let's do a candlestick. It's so hard to tell. I wish they would make it where you can. Let's see, 45. So I think 44 is 0.44. I don't know. It's hard to tell in this chart. But yeah, so that's how you do it. You just take the product of the prior stock splits. Same thing with a reverse stock split to figure out how much they were trading at. If you were curious, you have to take the product of the prior stock splits. But if you were just looking at they did a 3 for 2 in 2007. So if you were just looking at how much the stock price was in early 2007, you don't have to take the product of all the stock splits, just the ones that are after the date you're looking at. Apple did one many years ago. I think its stock was $500 before the split. That sounds right. Yeah, they were getting up there. Because they've only done 5. I guess that's possible. Let's see. They did 2 for 1, a 2 for 1, a 2 for 1, a 7 for 1, and a 4 for 1. So it's like they did a 224 for 1 stock split. I wonder if this website's missing some splits. I thought they would have done more, but I guess it's possible. So they're trading at 172 now. Yeah, it was 13 cents. So 13 cents at IPO. So you multiply that by 224, you get $29. Popcorn, yellow stripe, popcorn, yellow stripe, popcorn, yellow stripe. So what do you guys think? Are you buying Chipotle? Is it a good buy? It definitely seems overvalued. So their revenue is almost 10 billion. That's up. They grow a good amount. They grow about $1 billion a year in revenue. It was 7.5, 8.5, close to 10 billion. 9.8 billion from food and beverage, but they do make money from delivery. They charge fees when they deliver product. So that's 67 million in delivery revenue. Pretty good margins too. Their operating income 1.6 billion, net income 1.2 billion. So pretty solid margins. The net income went from 650 million to 1.2 billion. The earnings per share is $45, which is more. Their EPS is more than a lot of shares out there. So a lot of shares are like $20, $30, and their EPS is more than that. That's because the stock price is so high. Seems overvalued along with Wingstop. I'm thinking about. But what do you guys think? Is there another stock? I'll run a DCF. We'll do a little due diligence. So there, 10 billion of revenue. The largest expense is the cost of food because they have to buy the food, right? Even though they obviously got to pay a lot less than they charge you, they still have to buy the food, which is about 30% of their revenue. And what is that? It 30% seems good. It seems low. What cost of food? Does anybody know if that's margin? Food as percent of revenue. Okay, here we go. Most owners and operators keep food costs between 28% and 35% of revenue. Because if you were looking at a company's balance income statement and their cost of goods sold, which is the food cost, right? If it was like 50% of revenue, that would be really, really bad because there's really not much room to make a profit because you have to pay for a lot of other things. You have to pay for labor, which is the second largest cost for most food companies. That's about 25% of their revenue. So food it's very easy to look at because it's 10 billion of revenue. So it's very easy to calculate the percentage. So 30% of their and this is kind of like what you want to look at, whether you're looking at a public company like we're looking at now, or you're looking to maybe invest in a small, like a private company. If somebody's selling you their business or they want an investor, this is how you would do it. So you would take like their revenue. Okay. I'm rounding it to millions to make it easy to read. Okay. Just to get the formatting is a pain in the neck. Okay, 8, 6, 3, 4. I wonder if I could just copy it, and I think I could just copy it. Maybe not. Okay, forget about that idea. Okay. Okay. I'm late, so if you're going through financials, missed it. But if not, this is helpful. I just started the financial part. I'm just showing you like a process, a due diligence process. If you were looking to acquire another company or just invest in one. 2197 1917. Occupancy, I would just say like rent. Okay. So you kind of want to look at things as a percent of revenue. Okay. It's getting hot here. NVIDIA did IPO at a split adjusted price of 0.4. Weird. The numbers didn't match up, but it did an IPO. This is a much more mature company. Like if you were investing in a company that's been around for only a few years, the numbers might not be so smooth. Okay, so their revenue went from 7.5 billion to 8.6 billion to 9.9 billion. So their largest expense is food and beverage, the cost to buy those products. And you can see how much they've improved, because you would expect the cost of the food and the drinks would obviously go up because revenue's going up. They have to buy more. But the way you see if it's improving as you look at as a percent of revenue. So in 2021, 31% of their revenue were food costs, because they spent 2.3 billion in food costs and generated 7.5 billion of revenue. But they've improved that quite a bit. It went down 1% each year. But even 1% is really big, because 1% of 10 billion is like 98 million. So it's pretty significant, right? Even 1%. And you want to compare it to other companies if you can, if you have the stats. So you can see, I don't know how accurate this is. You'd want to compare it to real numbers, but this says food costs between 28% and 35%. So they're on the, they're on the lower end. They went from 31 to 29. But you want to compare, you might compare it to McDonald's or Burger King or whatever public companies that has some similarities as this company. Labor, which is the largest expense by far, is flat, even though it goes up each year. Let's bring it out a decimal to see if it's improving or not. It is improving. It was 25.4% in 21 and 22. It's down to 24.7%. So even that 0.7% improvement can be, $1 million or more. Rent is also improving. It's down from 5.5% to 5.1%. It's called economies of scale. As you grow your revenue, your expenses increase, but increase at a lower rate each year. So they're doing that really well. Because it's hard to look at numbers on a nominal basis. Because if you look at their rent, you see it's 400 million in 2021, then 500 million to 500 million. So it's really hard to tell. I guess maybe you want to bring it out another decimal. So it went from 420 million to 460 million to 500 million. So it's hard to tell if it's getting better or worse. But when you look at a percent, it's improving. Other expenses, and this is just how you do your due diligence, because I don't know what other expenses are. And they're pretty significant. 1.4 billion. That's not like this 36 million. That's peanuts. 36 million. But other operating costs. Like, what is that? So you just search the term. And then you figured it out. You just get more information. So next time you look at this company or a similar company, you might not have to. You might see other, and then I know what other is. It's probably marketing, advertising. I mentioned here. Other operating costs include marketing, delivery expense, bank and credit card fees. That usually 2% of your revenue is bank and credit card fees. Definitely credit card fees. Bank fees, maybe not so much. So 2% of your revenue. So 2% of that 14.5% is other operating costs. Insurance, heat equipment. Yeah, but this helps you get a more thorough understanding. So you don't have to spend as much time going back and looking if you've already done it a bunch of times, especially if you look at Chipotle again. You could always search these terms and read, but after a while, it starts to become second nature. So operating expense are all the expenses. So they give you percentages down here, percentages of revenue. That's kind of what I did in Excel. But they also have general and administrative, depreciation, amortization, pre-opening costs. So other operating expenses, it's 14.5% of revenue, which is, you see, I have it right here, 14.5%. And last year it's 15.2%, and it's 15.2%. But if you recreate it yourself, you'll learn a lot more than just, it is easier just to, if they do it for you, but you should recreate it yourself a few times before, because you do get better at reading the stuff. But if you want to know, not all the costs did go down, but if you want to know more information, they may provide it here. I guess if an expense went up a lot, they may provide more details, but labor costs. That went down, but you can read labor costs decreased 0.8% when you compare 2022 to 2023. From sales leverage, partially offset by 0.8% due to wage inflation. Beginning April 2024, California legislation will require national restaurant chains to pay a minimum of $20. That's a lot, right? To pay someone minimum wage. So this might go into your analysis, like how many stores do they have in California? What impact will that have on expenses? Because if that drastically increases their labor costs, then when they report their earnings, they're going to have a lower net income, and they might miss estimates, and the stock price may go down. This will increase wages in California nearly 20%. We expect to increase menu prices in California to mitigate higher wage costs. So they have to, obviously, you always pass on the expenses back to your customer. That's how you have to do it. So total operating expenses, it was nearly 90% in 2021. So only 10% or 10.7% was operating income. Look how much they improved that from 89 to 84. It's a big difference. that doubles their, because if you look at an income statement, too bad they don't have gross profit. This analogy works better with gross profit, but net income the hell? What am I doing? Okay. Okay. Okay, I guess it works better. Okay. So you see their revenue. Khaled, what's up? Good to see you. What did I learn? I learned a lot on this channel, pretty much. I mean, I did know it beforehand, but doing these videos and talking about it so much. Okay, so their revenue from 2021 to current, it went from 7.5 billion to 9.9 billion. So their revenue grew 31% in 2 years, right? Because if you add 31% to 7.5 billion, you get 9.9. I'll show you. 7.5 times 1.31, that's 31%. You get 9.9, you see? But their operating income grew 94%. Hope I could explain this. Okay, yeah. Revenue minus operating expenses gives you your operating income. So like 9.9 minus 9.9 billion of revenue minus 8.3 billion of operating expenses gives you operating income of 1.6 billion. So their revenue went up 31% when you compare 2021 to 2023. Their expenses went up 23%, right? So it's only 8% gap. That's the goal of any company. You want revenue to go up more than expenses, because expenses going up 23% is great if revenue goes up 31%, but expenses going up 23% is terrible if revenue goes up 20%, because your margins are shrinking, right? So it's only 8% gap, right? Because if revenue went up 31%, operating expenses went up 31%, the growth would be similar and your margins would be similar. But look how aggressive the growth is in operating income. It went up 94%. It nearly doubled with only an 8% gap. You would think, if I was to say revenue went up 31% and expenses went up 23%, what do you think operating profit went up? You would say, I don't know, like maybe 40%, because the revenue went up 31%. So obviously, if operating expenses, let me see if I can drive this point home. Okay. So revenue went up 31%. Let's just pretend expenses also went up 31%. Oh, no, I'm not doing it right. I need to do 30. I wish I could see the columns. Okay. I need to do F. Of course. I need to do, instead of E100, F100. Okay. It doesn't really matter what this is. I'll just pretend it's. Okay. So thank you, Khaled. You're always so generous. Okay. Here, I want to draw this point home. If revenue goes up 31%, it doesn't really matter what happens. Come on. Okay, this is. Okay. It doesn't really matter with 2022. It's irrelevant for the calculation. We're just showing when you compare 2021 to 2023. Okay. Okay. If we just compare 2021 to 2023, let's just pretend revenue went up 31%. Which it did actually go up 31%. And expenses went up 31%. What would operating income go up? Well, obviously it's 31%. Right? Because expenses went up 31% and revenue goes up 31%. So of course, your operating profit will go up 31% because you did not improve. Your margins didn't improve. You grew revenue expenses at exactly the same rate. But what they actually did, revenue went up 31% and expenses went up 23%. So therefore, their operating income, you would think their operating income would go up maybe 50%, right? Because it has to go up more than 31%, but it went up 94%. It's so exaggerated, right? It's only 8% gap. So that's how just cutting your expenses by 1% or 2% has such a drastic improvement on your margins. You could become extremely more profitable just trimming 1 or 2%. And I'm not talking about growing, because even if it was, okay, so if revenue grew 31% from 21 to 23, the only way your operating income would improve if expenses grew less than 31%. And I'm using the smallest. Expenses grew 30%. But look how much more your operating income improved. It grew 38%. So it's a big improvement, right? You see how exaggerated it is? Now, what if expenses grew more? So what if expenses grew 32% and revenue grew 31%? Then your operating income would only grow 21%. It went from 800 million to 1 billion. Not much of an improvement. What if expenses grew 33%? Then your operating income would only grow 12%. What if revenue grew 31% and operating expenses grew 36%? It's not that big of a gap, right? It's only 5%. But you actually are losing money relative to prior years. Your operating income is going down 13%. Maybe the next time I talk about this, I'll try to use a better analogy, but but focus on the income statement for a good company, not these crappy companies that most people look at. For a good company like a Meta or any profitable company, really, and you'll see how exaggerated the growth is as you go further down the income statement. It's hard to tell. And video may be a good one. Okay, like the very top of their income statement is revenue. Revenue went from 16 to 60. So if 4x, you multiply this by 4, it's roughly this. It's a little less than 4, but 4x growth. The revenue grew 4 times, right? But look at net income. It went from 4 to 30. It grew almost more than about 7x. It grew 7 times. So the growth is very exaggerated as you go down the income statement. If that makes sense. I don't know. Let's do JXN. I mean, is that too nuanced? I'm trying to get into like these. This is going to be a tough one, but we'll try it. Jackson Financial. 9.8%. Jackson taxes. What do you mean by that, Jackson taxes? 9.8%. Okay. It's a little hard to value financial companies. Jackson, the tax company. I never heard of that before. Well, they really have a pretty steep. They're expected to. I wonder why they're expected to drop so much. This might be a little tricky to do. Okay, 64.5. I wonder why they're expected to drop so much. Wow, really? Even with the big drop, let's raise the WACC to the highest, 11.3. No, make it more conservative. It seems pretty undervalued. It seems like a really good. Simply. Okay. Jackson provides annuities to retail investors. You know what annuities are? Like an insurance product. They operate through three segments: retail annuities. Annuity means an annual premium payment. Institutional products and closed life and annuity blocks. The retail annuities offers various retirement income and savings products, including variable fixed and payout annuities, as well as registered index-linked annuities and lifetime. You ever hear people like Susie Orman? They're like, "Don't buy annuities. It's a bad investment." Annuity. It occurs when a consumer receives a lot of negative things with annuities. This is where an agent intentionally omits information. Our annuities bad. Annuities can be a bad choice for some people. They have higher, the fees are really high and less flexibility. It's like an insurance, instead of buying term life insurance, which is like if you wanted to buy life insurance on your husband or wife, like if your spouse was the money maker in a family, and if something happened to them, they died or became injured where they couldn't work, it would drastically affect your life. So you take insurance on them. So term life insurance is usually the best choice because you just pay a flat fee, like maybe $800 a year, and you get a $5 million policy. But annuities are kind of like insurance and an investment vehicle. So you pay into the insurance like thousands of dollars, sometimes $1,000 a month. But what the insurance company does is they invest that money for you, but it also acts as an insurance contract as well as an investment vehicle. So the fees, I see those insurance selling commercials sitting in gold. I'd recommend just term life insurance. If you talk to these insurance salesmen, they'll really convince you to get an annuity. It sounds like the best thing in the world, but oftentimes you just lose a lot of money. because the fees are just pretty bad. Is it possible to lose money in annuity? Of course it is. Yes, you can. However, lose money on annuities if the insurance company that issued the annuity goes out of business and defaults on its obligation. There's a degree of regulatory. I personally, if I want insurance, I'll get a term insurance policy, and if I want to an investment vehicle, I'll just put it into my brokerage account. To combine the two, I'm not saying it's a bad thing, but I would just keep them separate. An annuity is a written contract typically between you and a life insurance company in which the insurance company makes a series of regularly spaced payments to you in return for premium or premiums you have paid. An annuity is not life insurance. A life insurance policy provides benefits to you, to your family if you die. But let's go back to this company. The institutional product segment provides traditional guaranteed investment contracts, funding agreements, comprising agreements in conjunction with the U.S. federal. So it's just, insurance companies can be pretty good investments. Buffett likes insurance companies like Geico. He owns 100% of Geico. Jackson. Let's see on Wikipedia if they have any information on this company. It provides annuities for retail investments, fixed income products. Jackson is okay. It was spun off in 2021. Jackson was a subsidiary of Prudential, which acquired the company for $600 million in '86. The company is unrelated to the American insurance conglomerate Prudential Financial, so it's Prudential PLC. PLC is a British thing. Public limited company. So when you see PLC, it's a UK term, a British company. It's not an American thing. Founded in '61 in Michigan. Jackson was named after Andrew Jackson. What's their let's see if this is it just started trading. It was 26, and it's up to, wow, it's trading at almost its all-time high, 60. So it's grown quite a bit. Look how many green candlesticks. It's done really well since it started trading. Sales. It is hard to look at sales for these types of companies. In 21 and 22 it was almost 10 billion. Now it's down to 3 billion. Look how much they're buying back stock. They really decreased shares outstanding. Usually, when you look at insurance companies, like the price to book is, I guess, the best indicator of, which isn't even on here. I don't have any insurance companies or banks in my portfolio. Well, I got Berkshire Hathaway, which is a big insurance, has a lot of insurance companies. Jackson Financial. Any other Jackson Hewitt? Yeah, I've heard of that. Any other tickers? People want me to look at? Okay. Operating earnings was pretty low in fourth quarter. Your book value, you want to look at book value, and you can see that's kind of steady. It's down a little from last quarter, up a little from last year. Total common shareholders equity. It's probably the only type of business that's harder to. Insurance companies probably have the most confusing financial statements, more confusing than banks. But I should try to do a video and really dig into it. But it is really confusing because it's kind of straightforward how a company like Apple makes money, right? They make a phone. And if you could break down all the stats and figure out how much it is to make one phone, say it's like $100. That includes obviously parts and labor and things like that. I don't know. Let's go higher. I don't know. $300. I'm just making up numbers. And they sell a phone. Say the average is like 800. So they're making 500 per phone. So it makes sense how they make money. They make a product and they sell a product. In order to make it, you have to not only make it, you have to market it. You get sued, so there's legal fees. There's a lot of expenses involved. The revenue is pretty straightforward. It's just selling the phone or selling a service you provide. So it's a little more straightforward, like how a company like that makes money. It's a little less straightforward with companies like this. Like, how do they make money? This is Chipotle. Well, they have to insure people, right? And then they receive premium payments. Like if you have an insurance policy through this company, then you pay them an insurance, a premium, maybe monthly or annually. And what's their expenses besides obviously payroll and all those things? Well, if somebody dies, they have to pay off the policy, or if somebody, depending on type of insurance. But how do you kind of like quantify that? It is a little confusing. But it looks pretty solid. Really good price to book, like 0.5, which is great. I mean, the lower the better. But when it's too low, you have to look into because price to book. So price is like market cap, the value of the company. So if the market cap was, say, well, what is the market cap? It's $5 billion. That's the value of the company, the price, the P, and the book value is assets minus liabilities. So let's say it's $2.5 billion. Oh no, wait, I'm sorry. Say it's 10 billion. So the price to book is 0.5, which it is 0.5, right? See, the book value is 10.3 billion, right? I just put 10 billion. It's pretty much 10 billion, right? That's how I knew the book value, the equity is 10 billion, because I know the stock price is 5 billion, and I know the price to book is 0.5, so it has to be 10 billion. So the price to book is 0.5 currently. What if the stock price goes up a lot? Say the stock price goes up to 6 billion. Now the price to book is 0.6. It's going up, so it's less attractive. The higher the price to book, the less attractive the company is as an investment. What if it doubles? It goes from 5 billion to 10 billion. Now the price to book is 1. They're trading at 1 times book value. If it goes above 10, they're trading above book value. So as the stock price goes up, it becomes less and less attractive. But on the flip side, the book value, if the book value improved, say it's 5, say the book value went up to 12. Now it's a 0.4. Why is it? So okay, let's do another one. LEU 4632. Centrus Energy 9%. Wow, look at that growth. 7 million, that's 23. 114 million, 135 million. This seems like a good value. 11.3. I'm at 74. It's trading at 40. Sometimes it's hard with these small cap stocks because even if they're undervalued, it may never go up, or it may take years to go up because the market has to find out about the stock. And most of the times, stocks under 1 billion really fly below the radar. It can take a long time. Revenue growth is pretty good. 247 million to 320 million. They're profitable. They're real profitable. Although their cash flow is going down a lot. It was 67 million. Now it's 9 million. So that's a little concerning. It looks like they're getting squeezed. Probably inflation. nuclear fuel. Nuclear power plants are a big industry. Advanced centrifuge technology to produce enriched uranium. I'm hearing a lot about uranium. I think it could be a good play if you want to get into uranium stocks. It seems like there's a lot of a big push. The U.S. government is really pushing for more uranium development, and I think they're funding. They're doing a lot of contracts, a lot of funding to companies that produce uranium. Centrus began work under a contract with the U.S. Department of Energy to build a cascade of 16 centrifuges in Ohio to demonstrate production of high-assay, low-enriched uranium. HALEU is required for many next-generation reactor designs, including 9 of the 10 reactor designs selected under the Energy Department's Advanced Reactor Demonstration Program. So it's nice when you get government funding, because it kind of eliminates the hassle of raising capital or selling products. Because how do you fund growth? Where do you get the money to fund growth? Well, usually you take on debt or you issue stock, but it's great when you get free money from the government. Another way to fund growth is to sell a lot of products and make a profit, but that seems a little difficult for some companies. Uranium stock, Energy Fuels. Okay. I'll be right back. Okay, selling products to generate profit is too simple for most. Exactly, it's just too easy to make a product and sell it at a higher price and contribute to society. It's too easy. Just raise capital, issue debt. Yeah, uranium could be a really good investment, but I think there was a really big run up on uranium at one point. Yeah, that 2021, I think, was that big run up. It's hard. Commodities. It's really a timing game. If you time it wrong, you'll never make money on a commodity. Yeah. Well, look at uranium spot price. It was 30 in 2020. It doubled in a year and a half. And then it came down in 2022. It's coming back up again. It doesn't look that great for this company. Why is uranium? Isn't there like a ticker that tracks uranium? Nothing came up, but that futures. UEC, uranium ETF. Maybe that's a good. Okay, you see this yeah, I'm definitely familiar with UEC. So in 2 years, this company, Energy Fuels, is down 36%. But the price of uranium is up 10%. And UEC, which is a pure play uranium company, is 43%. It makes you wonder, why is this stock? I mean, I know it's a company, so it doesn't track uranium, but why is this so far off? It's weird, right? Very weird. 48, 12.4. So West Rock Company. Let's see. The WAC is between 9 and 10.8. WRK, West Rock ain't going nowhere. Been following for a while. Watch me be wrong. Well, whoa, Blade, calm down. Calm down. They're up 68% in the past year. $6.50, 1.5. Pretty impressive growth. This looks pretty good. Their free cash flow is really expected to grow a lot. I'm at 59. What do you guys think of West Rock? I like East Rock and North Rock, but West Rock is a corrugated packaging company. It was formed in July 20. Look at it. It's only 9 years old and it already is 12 billion market cap. That's pretty impressive in 9 years to scale to 12 billion. It was formed from the merger of two companies, Med Westvaco and Rock 10. I guess Rock, Tennessee. West Rock is the second largest packaging company. It is one of the world's largest paper and packaging companies with 21 billion in annual revenue and more than 50,000 employees. 300 locations in 30 countries. They have a pretty wide reach. Wow. It's pretty impressive growth. Sometimes I like to see, who's invested in the company. I like to look at revenue, like for the past decade. It gives me an idea. It was $9 billion in 2013. Now it's $20 billion. So it's a decent growth. Not too aggressive in 10 years, but it's good. Okay, equity is higher than debt. They don't have much cash on their balance sheet. Yeah, I figured they pay a dividend, 2.5%. That's a good yield. It's a really volatile dividend payment. It was 6% in February 2020. The stock price came down, so the yield goes up. So you see stock price came down to, looks like it might have hit the low 20s. Yeah, they make a lot of paper, not as much as the Fed though. Nice. So they IPO'd at 56. They did a split. This looks like a good company to invest in. This is the kind of like stable, solid revenue, not these, these numbers that are just, all over the place, like real revenue, hard revenue. Like, the stock has not done that well though. It's actually down since IPO. It got up to 69, down to 24. See, price multiples, if you want to really understand the valuation, you need to look at the price multiples, because looking at revenue, looking at cash flow, you gotta equate it to the size of the company. So they're trading at less than 1 times revenue, at 1.2 times book value, 21 times forward PE. It's a bit high. It looked really good in early 2023 at 8 times earnings. So why are they? Okay, the revenue market cap has been going up, so that makes sense. So they don't have much revenue growth. That's the thing. I mean, that's a big thing with investors. They want to see a lot of revenue growth, like at least 20% a year. They're not really growing much, like maybe 5% a year. They grew 7%, 13%, and they went down. So in like 3-4 years, they grew 16%. So they're like averaging like 5% a year. In 3 years, they grew, they averaged 5%. So that's the only negative I see so far. Not that they can't grow in the future. I guess they're having a hard time scaling, or maybe they're not doing enough. Maybe they need to acquire more companies. CEO makes over $1 million. Not much insider activity. Lots of institutional ownership. Greenhaven Associates. Okay, it looks like a small investment advisory firm in New York. It only has 10 billion of assets under management. It's pretty small. So this is a pretty big portion of their assets. This is 640 million. They have 10 billion total. Nordea Asset Management. Nordea. Where is that? Okay. It looks like they're a European company. Nordea Asset Management. Okay, they're in Luxembourg. Pictet. A lot of unusual names I haven't heard of. Pictet Group, and they're in Switzerland. Siganti. They have a pretty wide reach. That's a Hong Kong hedge fund. Citigroup, BNY Mellon, Goldman, Pentwater. They have some unusual investors. Pentwater is a multi-billion-dollar investment management firm. In Naples, Florida. What's your best investments? Like, has it, like, in terms of either percent, like if you want to tell us like the percent, what's your best investment in terms of percent? Like, put the ticker and a percentage. My best was Apple. I sold it at 1,000%. I think I got it in 2012, and I sold it in like 2020. It wasn't much because I didn't have that much money in 2012. It was only like 1,400, and I sold it for 14,000. So Apple 1,000%. They make a lot of paper, not growing much. Tesla, yeah, Tesla is big for a lot of people. Nike, yeah, Nike kind of regressed a little bit, right? 94, 142. Did anybody buy Disney? I bought it when it dropped below 90. I'm still holding. I'm up like 30% on that. But I think that's a good long-term hold. One Oak, that's a good one. New, I'm up 170% on new. I have for like 2 years now. It's great. That was a real surprise. I didn't expect it to go up that much. But who's like me? Like, you're never happy when you make money. You're just upset you didn't put more money into it. Or you didn't dollar cost average down. I'm never happy. Well, not never, but I usually find a reason to complain about any investment. 5.6, 5.3, 5.5. Nike 9. Let's drop it to 8. Okay. Yeah, Nike's a tough one. Berkshire B at 180. Yeah, I'm up a lot on Berkshire. I'm up about 150%. Wow, you got it 180. It's 412. That's great. That's really, really great. 180, 412. I'm currently up 225% on Meta. $129%. Let me see. I'll bring up my portfolio. Okay. So the Meta in 2017, I kind of sold all my retirement and I changed my investments. So all these are from 2017. BRKA. You can see I kept adding spiders. I add a lot of spiders. I wish I added. Okay, so I bought Spiders. Spiders is up 102%. PDP is up 72%. Meta 235%. BRK 137%. PDP is just an index of a lot of different stocks. I should sell Meta at some point, but it's hard when you make a lot of money. You feel like it's your child. It's hard to let go. Yeah, their biggest. It's more of a mid cap index. O'Reilly Auto is their biggest. Apple is in there. That's come down quite a bit. But I kind of like, I'm trying to view these stocks as like I hold till I retire, like, and I ignore the ups and downs. This was great, 189% on new. I just got real lucky. I bought it almost at the very bottom in June 2022. I got it at $4.23 a share. And then ET is up 80%. Johnson & Johnson is still down. I have Meta in a different account. That's up 52%. And then I'm down on these two, but yeah, whatever. Yeah, but I should sell Meta. I don't know. I still think it has a lot of room to grow. I hope I don't kick myself. 393. You got new at 393, but only you mean you sold it at 10? Is that what you mean? You sold it at 10. Still, that's a pretty good return. I know it's when you see these big gains, it is hard to sometimes hold on to it because you're scared it's to go down. No, I only got got 10 shares. Well, I had crypto investment. I bought 2K. I bought a 2K top at 52K. I didn't sell though. Oh, so you bought 2,000 and it was worth 52,000? That's some. A win is a win. No, it's true. I mean, you can't. Nike's it's tough to look at valuation with a company like Nike. It does seem overvalued, but it's a good company. And some companies just grow into their valuation. You just have to give it time to breathe and make money. Yeah, it's a good brand name. That's what I try to do generally when I invest is buy companies that are kind of have a good name, a good brand, that are, really well known. I don't always, but I try to. So Nike, remember the 90s with Michael Jordan? That was the big run up. Look how low it was then. God, it's hard to look at this chart. Okay, 2012. Oh, they make it really hard to read, don't they? Wow, it was under $10. This is obviously split adjusted. In 2004, it ran up to 170. So it's currently trading at pre-COVID levels. It's getting close to pre-COVID. Pre-COVID, it was under 100 before COVID. And it never got to 100 until COVID. I think once, it's a bit rich, 170, 180 for the stock. I do think 130, 140 is a good level, at least at their current rate or the current future. But I think in 10 years it should be triple what it is now. But are they losing their mojo? Is Nike not? I swing Neo once a month and sell one up 5%. That's pretty good. Those EV companies sure fell off the earth. Remember how EV companies, that's all you talked about for a good 2-3 years? Now Look at Neo. It was over 60. It's like it's down 50% from IPO. It was actually lower in 2019 than it is now. But remember, remember a huge run up for Neo. Who are the other? There's another big EV company. They're like Neo, Tesla, and who's the other one? There was another like Beyond. Was that it? Beyond? I thought it was. Who is it? A Lucid. Yeah, Lucid. I think I'm thinking right. And Li Autos. They've really, and it was so obvious that it was going to come down. Tesla is the only kind of safe bet for EVs, but it was so overvalued. I mean, it was extremely overvalued. Now it's just slightly overvalued, but I mean, it's not that great of a company, Tesla. Unless they really get into AI and autonomous cars, but I think that's the only thing holding up the stock is the idea that they're going to break into autonomous driving. But it belongs much lower. Like they're like I'm being generous at 300 billion market cap, but I think it's close to 200 billion. They really belong about 200 billion. I mean, if you want to just pure fundamentals, they're at 100 billion, but just to be a little generous, I think 200 billion is an okay level for them. They're just, well, look at Lucid. Look at that. Look how volatile Lucid is. Wow. Look how much it went up 4,000% from IPO. And look at it now. It's still up 100% from IPO, which is still pretty good, but in 5 years, Tesla is up 768%. Well, at least NVIDIA, their fundamentals indicate they're not that overvalued relative to their fundamentals. I mean, Tesla, let's see what they're trading at. I mean, at least they finally came down to earth. For a while, they were at like 200-300 times earnings. Now they're at least at a normal level, still overvalued. 40 times earnings is a bit extreme, especially for a car company. Because look, will you check Gary Network once? Coke has traded rich. Because if you bought like a small business, like a private company, if they were asking for 5 times earnings, that would be like almost a joke. Like usually you give 1 or 2 times earnings. In a really extreme case, you might go 3 times earnings. But these publicly traded companies are like 20, 30, 40 times earnings. Which is just nuts. I mean, at least they're coming down to earth, 36 times earnings. Because it used to be like 500 times earnings or like 1,000 times earnings. Like Toyota, by far the best car company in the world. They probably sell, for every car Tesla sells, Toyota sells 50 cars. Something like that. And they're much more profitable, Toyota. And they're still smaller. They're still smaller than Tesla. But they're getting there. They're closing the gap. Because if you think this is accurate, 345 billion market cap, which is probably, I would say that's a good value for Toyota, then Tesla cannot be 345 billion. There's no way it should be bigger than Toyota. And there's no way it should be a little, it's not even a little smaller than Toyota. If 345 billion is accurate, like let's convert all these market caps to Toyota's PE. Say Toyota has the right PE, 11 times earnings, which I think is a good level to trade at. 11 times earnings. Let's pretend everybody was 11 times earnings, like Toyota. I'll say, so to calculate their earnings, we know their market cap, 542 billion, and they're trading at 36 times earnings. So their earnings are 15 billion because they're trading at 15 times earnings. So these are the real earnings for these companies. So if we fix everybody's market cap to trade at a normal level, that means Tesla should be 163 billion market cap. Let's just get rid of these crappy companies. And you can't even do it because they have negative earnings. So you can't even calculate it. I mean, you could do it as a multiple of revenue. So this is what the market cap should be if we lived in reality, not in this market absurdity. See, can I sort it? Will that work? Let's see. Okay, if we lived in reality and everybody traded at 11 times earnings, Toyota would be the largest company, which makes sense. Stellantis would be second largest at 225 billion, which probably makes sense because Stellantis is besides Toyota probably is the second best car manufacturer. They have a lot of big name brands. They have Dodge, Maserati, Chrysler, Fiat. Some of these names are more European. Like you won't see, well, Ram is American, but you won't see it. Like Romeo is a Italian luxury car. Well, Alfa Romeo. So a lot of these Italian cars, but so if we lived in a normal world, this would be the market cap, the top companies. Toyota would be number one, then Stellantis, then Tesla, then GM, then Honda, Ford, Li Auto. Ferrari, it does say they're 15 billion, but they're in a different kind of like category because it's really a specialty car. So they currently trade at 56 times earnings, which is the worst of all these car manufacturers. But it's a different kind of company. They have a specialty brand, so people are going to pay a lot more for a Ferrari, and there's always going to be demand. So I think they deserve to be trading at such a high multiple. But Tesla doesn't deserve to be trading at 36 times. They should be trading maybe 20 times. Tesla has more growth than its peers. I don't know. Like why Toyota? Why doesn't it have as much growth? I mean, they have really good cars. They can get into EVs, maybe not to the scale of Tesla. They could sell a lot of EVs. I mean, if you consider these Tesla a manufacturer of vehicles, then this is where it belongs. But if you look at Tesla as a battery maker, if you look at it as different than a car manufacturer, then I guess I understand. Is Toyota going to have good self-driving anytime soon? I don't know. I mean, I don't think it's going to be a huge factor, self-driving cars. I don't think it's going to move the needle that much. Sure, it's cool and you'll get sales, but I don't think it's going to be anytime soon, maybe in 100 years, but I don't consider it being controlling the market. A lot of people still don't feel comfortable having autonomous cars. There's going to be the subset of people, I'm saying EV cars, people like EV cars. Not everybody is buying an EV car for various reasons, but I think people like the idea of EV cars. Self-driving cars, it's a very small population. I would love a self-driving car, but Sun is owned by ET. Sun is trading higher. Is that because financials are better? Sun is not owned by ET. Wait, let me take that back. No, it is. What am I saying? It's not trading higher. It's trading lower. ET is 52 billion. Sunoco's 5 billion. ET is 11x or 10x. Well, why isn't NVIDIA getting into robots? A sector Tesla's in. They just have so many areas. No, I think NVIDIA is AI is going to be really big, and a lot of industries will use AI, and it will save on payroll, things like that. It's just Tesla is in a narrow market. Its only play is automobiles. It's just a huge hurdle to get people to sit in a car, self-driving car. But NVIDIA will have a lot of, there's so many industries that will use AI. But, I'm not saying I'm right. This is just my opinion. Yes. Sun is trading higher. Is that because their financials are better? Oh, you mean trade? They're trading higher. You mean their price multiples? Okay, it's trading at 9 times forward PE, and ET is trading at 9.5 times forward PE. It's pretty similar, right? Would you buy NVIDIA at its current? I probably wouldn't, but I don't think it's overvalued. I just wouldn't buy it. I'm kind of scared that it's going to come down a lot, but I think it's a good value, a long term. But there's got to be a pullback. You would think it's going to come down, but I'm just pissed off. I didn't buy it before the big run up. I totally missed the boat. I didn't connect the I didn't realize how good their semiconductors are, how much better they are than their competitors. But they have great margins, amazing growth, lots of revenue, and lots of the pipeline is really. I think Apple. I think it's getting better. The price point, it's very appealing, but I think there's a lot of downside. I could see it coming down quite a bit due to market fear. So I think it's a good value now, but I probably wouldn't buy because I do think it's going to come down a lot, just like Meta came down a lot out of all that fear. I think it could hit 100, possibly cut in half from this point to 90. So I think there's a lot of potential to pick it up at a lower price. But the problem is when a stock is going down, people will always think it's going to keep going down. Like, remember when it was 370 and then it started coming down 300, but nobody buys it. Not nobody, but most people just think it's going to keep going down, and they I think it's going to keep going down. I'm too scared to buy it. And then before you know it, it shoots back up and you never get it. So you just got to buy it at some point. You can't wait for the very bottom. Tesla, the company, doesn't exist to make share price higher like most companies do. No, I don't think they're justified. I think, people are entitled to buy what they want to buy. It's not like you live in a community where you have to get gas and electric from one company. Like usually people are kind of like locked in to like one type of company to buy your utility from. It's not like that. Well, you could buy whatever phone you want. Just Apple makes a better phone, so it's like you can't succeed in business without like government trying to limit your growth. You can't get too powerful. But I do think Tesla, if they get more into EVs, AI and batteries, I think there's definitely that potential to grow exponentially. But they really need to, I think, scale. I think the cars this is not profitable enough to get back up to over $1 trillion. Yeah, that's the thing. Yeah, Apple does. Yeah, I've been kind of bearish on Apple for a few years now. I've been wanting to short it. I've made a few videos on that. I just don't think. Yeah, they're not innovative. They just have one product that's like 70 to 80% of their sales, the iPhone. Without the iPhone, they're nothing. So I don't know. But they could be a good AI play. I don't know. It's really hard to tell. I wish I shorted it, but I probably would have timed it wrong. Because I was thinking of shorting it, but I probably wouldn't have made much. At what point would I have shorted it? At 196? If I did, I was thinking for a while, like for like a year or so, it's going to come down a lot, but it just kept going up. It has come down, but not that much. What is it down? 12, 15% from its peak? And fundamentally, the revenue is down, but they're still like, 100 billion of profits. It's a lot of profit. Still like a ridiculous amount of free cash flow, 100 billion. Look at NVIDIA. They're, a quarter of Tesla size in free cash flow, and they're not that much different in price, right? It's 2.4 trillion, and what's Apple? What, 2.8 trillion? 2.7. So they're pretty similar value. Apple's maybe 15% higher, but 4 times the free cash flow. Why do you buy so much Bank of America? He's just he's big on utilities and banking and railroads. That's his big thing, and insurance. Banking. I don't know. I don't really buy banks too much, but maybe I should. I don't know. He's probably the biggest shareholder. Yeah, he owns 13% of Bank of America. He doesn't buy JP Morgan. He buys Bank of America. And banks generate a lot of cash. It's recommitted to his favorite bank stock, Bank of America, during the first quarter, while dumping two other banks as part of a number of moves. Provide a quarterly update on U.S. holdings. It increased its 179 million share stake in Bank of America while eliminating U.S. Bancorp and BNY Mellon. It's confusing. I have a hard time looking at a financial statement for a bank and really, really understanding it. The quarterly filings don't identify which investments Buffett made and which ones were done by one of Berkshire's two other investment managers, but Buffett generally handles all of Berkshire's biggest investments worth $1 billion or more. He continued to reduce Activision Blizzard stake in the quarter, 49 million shares. I guess that's his Microsoft play, Activision Blizzard. Because Microsoft acquired Activision Blizzard, but he doesn't own Microsoft, which is odd, because he's friends with Bill Gates. Berkshire continued to reduce Activision Blizzard stake down to 49 million shares. Buffett said he bought that stock as a way to bet that Microsoft acquisition of the video game maker will ultimately go through. That deal is in doubt after British regulators rejected it. Wait, so it didn't actually go through? I thought the acquisition was completed on October 2013. Oh, so it did go through, yeah. This must be an older article. May 2023. Berkshire also cut GM investment to 40 million shares. He wanted to sell more of its stake in Chinese electric car maker BYD. He's been going in heavy on Japanese stocks, so that's something to look into. If you want to get exposure to Japan, buy an ETF, a Japanese ETF. What are good Japanese ETFs? Japanese beta builders. Does anybody know any good ETFs? I don't hedge. I don't really buy. I used to buy gold, but it didn't even seem like it was a good hedge. I guess I'm in for the long haul, so if it goes down a lot, like I was down like 70% on my Meta. I put 100,000 to Meta, and I was down to 30,000. Now I'm at 150. So that's my hedge is to just wait. Not the best hedge, but this is a China A series ETF. Is that China or Japan? I think this is Chinese, not Japanese. Yeah, I think it's Chinese. Would you like to see TikTok ban? I mean, China doesn't let our tech. Yeah, right. Wouldn't it be nice? Because they ban us. Why do we? But we're all about making money. We don't really get into like those types of things. But yeah, Chinese government, they just don't want to. They don't want a successful country. They could. I mean, they're second to us. They could be even way further ahead if they didn't try to limit all their, not all their businesses, but a lot of the businesses. They're really, they have a stranglehold on trying to stop them from succeeding by letting them go into the U.S. market and letting them expand and grow. I mean, we have the best economy in the world. We have the most money, the most disposable income. We spend more than any other country. That's why every business wants to have a presence in the U.S. I mean, I wish they let just Meta acquire TikTok, and Meta would make more and more money, and TikTok would make more and more money and supply a lot of jobs. Yeah, MSCI. Wait, what is it? I always forget. What is MSCI? MSCI is an American finance company headquartered in. That's the world index, right? It's. Yeah, that's all countries, right? What's okay, Japanese stocks. Okay. They have a great economy, Japan. Like really, they're kind of like, because you wanna own stocks in a country that is all about making money and growing and scaling. A lot of European countries, they're just too. It's good, but they're just too focused on like living a good life, like being happy. We're just all about money and like working a lot, and which I don't think is a good thing for to live, but to invest it's good. Because a lot of European people from Europe, they take long vacations. They don't like to work long hours. It's a great place to live, but to not the best place to invest in. What are the best Japanese secure? They have a lot of good banks, right? Japan has some really good banks. Sumitomo, Toyota is a good company. Can you invest in the Nikkei index? Okay, Nikkei. Look how much they've gone up. In 2 years, I mean, went from 28 to 40. So it's like 50%. So it's really their economy, their market. And I think they're finally going to raise interest rates for like it seemed like forever, like 15 years, they had negative interest rates. The inflation was like zero for like ever, or negative. Like when you have negative inflation, that means you have to pay banks to hold your money, or or if you put money into a bank, if you put like $100 in a Japanese bank, you lose money by putting it, by them holding it for you. You actually lose money. They don't pay you interest. They take money away from you. That's deflation. So you can see it was like, it's finally at a normal level. Hey, Paul, thanks for the sticker. I appreciate it. Look at it. Like, look at they were negative 2% in 2009. Like, they were pretty much hovering around zero for like 2 decades. I mean, crazy inflation in the 70s. I mean, that could really kill your economy with this. But I mean, they weren't that great of an economy. I mean, they were a good economy, but they weren't that great until like, I remember when I was younger in the 80s, in the 90s, they really, strengthened their fiscal policies. A market open live stream? You mean when a market opens? I did that I remember when I wasn't working and I was doing that. I did a aftermarket stream, like when a market closed. I would do a summary, but I don't know. I kind of work now. But anybody have any idea for another stock to look at? Any throw out a ticker. Not an insurance company or a bank, like a real company. Like, throw out a ticker, and we can do some due diligence at DCF on it. Okay, Paul, I got your comment from the Netflix. Yeah, Baba's a good one. Baba. Like a really low whack. Yeah, so the whack is how? Okay, so the WACC, the weighted average cost of capital, is a blend of the cost of equity and cost of debt. So here's a quick calculation. So to get your cost of debt, it's the interest you pay on your debt. So say you pay 5% interest, and then how much debt do you have? Just pretend you have $1 billion of debt, and your equity, let's pretend you have $3 billion of equity. So that means you're 25% debt, 75% equity. And your cost of equity is usually based off your beta. That's the volatility of the stock. Equity is more expensive than debt. So if your cost of equity is 12%, your cost of debt is 5%, and you have 75% equity, 25% debt, then your WACC would be 10.3%. It's just a blend of the two. Wait, what were we just doing? Baba. I own Baba. I ended up selling it. Yeah, I just lost faith in the company. It's too volatile. Those Chinese stocks, they don't. It's such a good company, but the Chinese government just won't let companies succeed. 72, 182. I mean, they generate so much cash. Baba. They're just a cash machine. 167, 180, 198. 167, 180, 198. Look at that, $1,300 stock price. I'm joking. I got to convert from CNY to USD 0.14. Usually you just divide by 7. Like market cap, well, that's US dollars. But if they have 167 billion of free cash flow, that's a projection for 2024. If you want to convert that to US dollar, divide by 7. So it's like what, 22 billion? So I'm at 188. I think I'm gonna raise the WACC. So I'm gonna make it real as conservative as possible. They have so much cash. Yeah, I know. They're like, even with so much cash, like they have $600 billion and they have 40 billion restricted cash. So that's 640 billion, which is like 90 billion of cash, US dollars, 90 billion. So half their market cap is cash. It's a lot of cash. 90 billion is a massive amount of cash. Not many companies have that much cash. Berkshire is one of the few companies that has more cash. But what's a company with a Tesla? Let's see, like, much bigger market cap, 544 billion. That's triple, right? Triple Baba's market cap. Baba had 90 billion of cash. They have 29 billion of cash. So they triple the size with a third of the cash. There's just so much cash, 50% of the value of the company. But it's just a Chinese government. They just won't let them succeed. Yeah, Google has a ton of cash. Meta has a ton of cash. Microsoft has a ton of cash. Microsoft might have more cash than anybody. Maybe not Berkshire. But Microsoft, they just keep a lot of cash for some reason. They have, 80 billion. So less than Baba. 80 billion of cash. So Berkshire, I think, has the most cash out of anybody. Berkshire has it's hard to tell because how much okay 168 billion of cash. It's hard to tell because the cash, they have a lot of cash in their insurance business that it's hard to tell looking at the balance sheet. If we looked at their real balance sheet, it would be probably easier than Yahoo Finance. This is hard to find. So here's their real balance sheet. So cash, 33 billion. Short-term investments is cash. So 162 billion, 163 billion. Is that what? 168 billion. 163 billion. Okay, here's 4 billion of cash. So 163 right here plus 4 is 167. Okay, rounded 168 billion of cash. See, that's right, 168. Apple's probably close to 100 billion, right? $70 billion of cash. That includes cash and short-term investments. 70 billion. Google probably has 50 billion of cash. But you have to look at it relative to your market cap. 110, wow, 110 billion. But they have a lot less cash than Baba relative to their market cap, because they're 1.9 trillion. So they're only 10%, no, 5% cash. Baba is 50% cash. Shopify, that's a good one. Shopify. That's a nice Canadian company for you. 101.79. $1.2, 1.72. You could buy Baba and sell it, but the Chinese government wouldn't let you do it. Chinese government controls the company, so you couldn't really do anything. Yeah, Shopify seems pretty overvalued. Wait, 100. Wait, no, I did it wrong. Yeah, it's really overvalued. They're trading at 78 times forward PE, almost 800 times earnings, because they're not earning anything. their earnings, yeah, they just started becoming profitable. So you have to pay such a premium for these stocks. It's like you're so late to the game with Shopify. And the funny thing is, look how much higher it was in the past. It was over 170. You know, if you were really shrewd, a really shrewd investor, you could have got it below 30. I mean, how would you know that's the bottom, though? I mean, you could have got it 80 when it was 50% below its peak, and then you would have been down 50%, but now you would have been even. Yeah, Shopify. Good. Yeah, but okay, it's a long stream, right? 3 hours. So okay, yeah, thanks for joining. I'll try to do it tomorrow. And yeah, thanks for everybody commenting. And yeah, these are good streams to just look at companies and do some due diligence. Okay, yeah, have a good night.